If we could only pick one fund for retirement, we'd choose QQI. This article was written by Prop Notes. Summary: NEOS NASDAQ 100 High Income ETF's strong historical performance, consistent payouts, and smart construction make the ETF an attractive income pick. While volatility is typically a big negative for covered call funds, QQQI has performed well in recent months, giving us confidence for the future. We're reiterating our buy rating on QQQI. In previous articles, we've iterated and reiterated some version of the following belief. Wealth accumulation happens in your working years when you're invested in appreciating assets and contributing regularly to a growing investment pot. Then, once you retire, your relationship with your brokerage account flips. You reallocate into income-paying instruments and begin taking distributions to fund your lifestyle. Put simply, in our view, this is the ideal investment life cycle that most should aim for over their lives. About a year ago, we wrote an article titled QQQ: Why It Could Be the Best Single Investment for the Next 20-plus Years. In that piece, we made the case that QQQ, based on the NASDAQ 100, was the single instrument most likely to produce strong, long-term returns. Why? Simple. The fund invests in top American companies in the tech, XLK, and consumer cyclical XLY sectors, areas of the economy which have high leverage to economic upside. Given the strengths that America possesses, it has been and should continue to be a strong bet. Thus, QQQ appears to be an excellent choice for the appreciation phase of the life cycle we described above. But what about when you retire and begin switching to an income focus? QQQ pays meager dividends, and even with dividend growth, you're unlikely to enjoy substantial distributions in retirement. But what if there was a way to leverage the upside of the NASDAQ 100 to generate substantial cash flows that you could use to fund your retirement? This is the promise of QQQI, the NEOS NASDAQ 100 High Income ETF. As a high-yield ETF, this fund is solely focused on selling covered calls on the NASDAQ 100. We first covered QQI a few months ago in an article where we compared it to JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. As another high-income NASDAQ option fund, JEP has a lot going for it. That said, we think that QQQI is the fund to own in the covered call space due to a unique trading strategy that should drive long-term income production. Today, we'll dive deeper into QQQI's value proposition, take a deeper look at the fund's historical performance, and explain why, if we could only own one fund for retirement, we'd choose QQQI. Sound good? Let's dive in. QQQI's construction. Let's start with a briefing on how QQI works, in case you've never heard of the fund before. In short, QQQI is similar to a number of other covered call income funds, insofar that it selects an underlying asset, in this case in NASDAQ 100, and then sells covered calls continuously on it in order to generate payouts to investors. This is similar to a wide range of other ETFs we've covered, including QYLD, JEPI, and TSLY. We're not fans of most of these funds, as we've found that high payouts and mechanistic call selling tend to lead to NAV destruction over time. Functionally, many of these funds pay out harvested option premiums, whether or not those individual trades actually generated a profit, which, when combined with fees, has led to considerable NAV decay over time. Who wants to invest in something that loses value? If you're spending the income you're making from these assets, then falling NAV over time can be a real problem in retirement. As we see it, QQQI is fundamentally different. This fund's key innovation is that after selling covered calls, it chooses to spend a small portion of that income to buy upside protection in the event that the NASDAQ 100 rallies considerably over the course of a month. That way, the fund trades some current income to retain some of QQQ's appreciation profile. Here's what the payout diagram looks like for most covered call funds in any given month. And here's what QQQI's payout diagram looks like over any given month. See the difference? This added upside changes the game when it comes to income production and NAV protection. Distribution-wise, QQQI does distribute this premium to investors, so in that way, this form is definitely not a capital appreciation vehicle. However, we'd argue that in down markets, choppy markets, or slightly uptrending markets, QQQI may actually have an advantage over the underlying index in terms of total returns. Only in true growth scenarios or strong trends Does it appear likely that QQQI will underperform materially? QQQI's performance. Let's now take a look at QQQI's historical performance. This is really where the rubber meets the road and where we can determine whether or not the fund actually does what it says on the tin. Thankfully, and as you may have guessed from the title of this article, we're incredibly happy with how QQQI has performed over the last few years since inception. As it turns out, the fund's clever construction, which reinvests some premium into upside mitigation, has done an excellent job at both retaining NAV within the fund and paying out consistent distributions to investors at around a 14% dividend rate. Not too shabby. First, let's look at returns. In the white, we have QQQI, and in green, we have QQQ. As you can see, QQQI does underperform QQQ if you're looking purely at price. This, of course, is due to the fact that QQQI employs the aforementioned options overlay that restricts upside growth in return for crystallized payouts to investors. However, if you're looking at total returns, when you add back in QQQI's dividends, you'll find that since inception, the fund has generated a very similar total return to the underlying index. While some may argue that this period in the market has not been a true test of QQQI's performance, we would actually argue the opposite. Since QQQI's inception, the fund has had to keep up with the index's strong appreciation. Then, in the early spring of this year, QQQ sold off precipitously on the back of this administration's trade policies. QQQI is expected to outperform in choppy or down markets, but quick drops and strong rallies are not suited to the fund's construction. Nevertheless, and this is the real trick, QQQI has not underperformed QQQ on the rebound in total return, something that has historically plagued other funds. Year over year, QQI's total return was 14.87% compared to QQQ's 14.88%. One of the biggest risks with covered call funds is that a large sell-off won't be recovered nearly as quickly due to the fact that a quick bounce back will be suppressed by short options exposure. As an example, look at how XYLD, another covered call fund, performed following the COVID crash and ensuing rebound. The short options exposure capped upside at the wrong time, dooming investors to years of underperformance. QQQI appears to have struck a happy medium in this regard, even considering the recent volatility. Finally, when looking at QQQI's distributions, you can see that the ETF has maintained a strong payout rate of roughly 14% over the last few years. This is impressive for two reasons. First off, generating a stable 14% yield from a mechanistic options strategy is highly impressive and largely down to QQQI's clever construction. Secondly, and more importantly, if you look at the yield on cost curve, you can see that QQI has not seen any yield decay as a result of the upside hedge approach. This differs from what we see in the industry more broadly, with funds like QYLD, which act more as an annuity and less like a consistent source of distributable income. QQQI's consistent payout regime is a refreshing change of pace and a key selling point for investors. Ultimately, when you buy into an income investment for retirement, you want that investment to sustain you through retirement, not dribble out as time goes on. So far, QQQI has done an excellent job of stabilizing payouts through multiple market types, which gives us confidence that the fund should continue to do so. Of course, the key risk here is that QQQ has a proper crash. This is a statistical probability, and we'd regard that as QQQI true test going forward. Will the fund to be able to climb out of that hole as quickly as it did this one? Only time will tell. Summary: overall, though, when it comes to selecting an income investment for retirement, we think that QQQI has many of the properties most people should be looking for, including a strong, well-backed yield, consistency through market volatility, and a clear value proposition. While the fund has a relatively short track record and will need to prove itself again in the event that markets become volatile, we'd argue that the fund's clever construction, strong track record up to this point, and excellent choice of underlying instrument should propel strong total returns and distributions in the future. Thus, we're reiterating our buy rating on QQQI. Cheers. This article was written by Prop Notes.